Hello, everybody. Ed Denny here. You can see it's quite a bright day. I have some shades on the sliding door here, but it's still quite sunny. We've had a very nice summer. It's been sunny most of the time. We've had some rain, but all in all, here in New York, we count ourselves lucky compared to some of the extreme weather conditions that have occurred in other places around the country and around the world. We also had my wife and I, my family had a very nice Labor Day. Didn't do much other than had some nice barbecues in the backyard. I hope your summer went well. It's a memorable one. It went by way too fast for us. I presume I can't presume how quickly it went for the rest of you, but it was certainly one of the fastest summers I can recall. And here it is already September 5th. Before you know it, it's going to be Halloween. Then we'll have Thanksgiving, and then we'll have the holidays at the end of the year and New Year's. So everything's kind of coming to a close here on 2023. Of course, the stock market always thinks ahead. So the stock market's already thinking ahead to 2024 and even 2025. I recently pointed out in one of our publications that we now have data for analysts' consensus expectations for 2025, and they're quite optimistic about earnings out that far out. Of course, they always tend to be optimistic. The further out you take them, the more everything is going to be hunky-dory. But I tend to agree with their outlook. I think things are going to continue to work out pretty well for the economy, for consumers, and for earnings, and for the stock market. But for the here and now, we need to discuss some things. I should have pointed out that Max has joined us again. One of these days, he might actually be awake for this thing. And then I want to thank some of you for pointing out that I wasn't getting it right. I'm not sure that I still am getting everything right in this homemade production of mine. But some of you were complaining about the audio, and now I'm very happy with my Yeti here. That's what it's called. It's a Yeti microphone, and the reviews have been rave reviews, not about what I'm saying, but about what Yeti is hearing and pushing along. Well, last week we talked about Fed Chair Powell's speech at Jackson Hole and made a list of all the things that he's concerned about and all the indicators that he's looking at. This week in the morning briefing, we continued that conversation, that topic, by pointing out that some things are actually already working out along the lines that Powell said he'd like to see happen. The speech itself was very hawkish, but when you look at the set of data points on his dashboard that he's looking at, I think we're making some progress in that direction. So it's hawkish, but if we keep going in the right direction, I think that'll be a good thing, and it'll reduce the likelihood that the Fed has to keep raising interest rates. Powell stressed that he was laser focused on inflation, and that until the Fed was convinced that inflation really is moderating towards its 2% target, that interest rates would be kept at these levels at these higher levels for longer. But he also made it clear that if he wasn't convinced, and other Fed officials weren't convinced that they were making progress towards 2%, or God forbid that the inflation starts actually going the other way back up. As you know, on social media, one of the charts running for economic matters is the inflation picture for the 1970s, and we had two peaks in that period, and that's the concern that people have now, is that okay, we may be seeing some improvement here in inflation since last summer, some moderation, but let's not get too excited, because if it's a repeat of the 1970s, we'll see inflation moving back up again for a second peak, and then inflation will come down, but only with a recession. The 1970s had two pretty awful energy crises that certainly led to a big rebound in wage inflation through cost of living adjustments. This time around, we have had a sort of a mini energy crisis at the beginning of last year with the Ukraine situation, the Ukraine war, Russia's horrible invasion of Ukraine, to be exact. But we so far haven't had a second energy crisis. So maybe we're working on one now. We're seeing energy prices moving back up. I think a lot of that has to do with the perception of demand that China may stimulate its economy. The Chinese government may stimulate its economy, and that may get things moving again. But here in the U.S., the Fed chair has made it clear that he wants to see us moving down towards 2% on price inflation. Particularly, he focused on core PCED. So he did rightly point out that there's not much the Fed can do about energy prices and food prices, that they have their own supply and demand, and they tend to be quite volatile. Of course, the Fed can do something about energy prices and food prices to bring them down. It could always cause a bad recession, but the Fed chair has indicated a few times, several times, that he thinks that there is a way to get inflation down without a recession. And as long as that seems possible, I think we're going to stay on that course. If that suddenly seems very unlikely, then obviously the Fed will do what it takes to cause a recession to bring inflation down. But in previous commentaries, Powell has made it clear that he thought that in order to bring inflation down to 2%, price inflation down to 2%, we have to see wage inflation coming down to 3%. Right now, it's running more like 4 to 5%. He also said that he'd like to see the labor supply demand situation rebalance, where there's more supply and less demand, so that that would take the pressure off of wages and reduce some of the strength that we're seeing in the economy, particularly the consumer. So that's sort of the third area of concern, that consumers have been red hot recently. We're seeing consumer spending rising at over 4% on the Atlanta Fed's tracking model for real GDP. And he made it clear that he'd like to see that slow down. Well, let's see whether his wishes are coming true or whether we're on the right path in that regard. So let's go to the to the charts. And here on my handy dandy touchscreen monitor, let's first of all look at the story that has been preoccupying the markets since the beginning of last year, and that is hard landing, soft landing, or no landing. For a while there, nobody took no landing as a serious scenario. The big debate was hard landing versus soft landing. And as you know, we've been talking about a soft landing scenario based on a rolling recession paradigm, different sectors of the economy getting hit with a downturn at different times and not adding up to an economy-wide recession. I thought it might be worthwhile just to revisit a couple of charts that supported that view, the possibility that historically there is a precedent for a soft landing in the economy. And during those soft landings, we did see some moderation in inflation. So we can look at the mid-1980s. If you look at the growth rate in industrial production, it came down to basically zero here in the mid-1980s. Then it picked up again. In the mid-1990s, you're not seeing it that much here, but there was some slowdown in industrial production on a year-over-year basis. And certainly here in the mid-2010s, you're seeing that. So we've had mid-cycle slowdowns, we've had growth recessions, we have these soft landings that occurred in the past. And I think that's what we've been experiencing of late. It doesn't feel like, it certainly doesn't feel like a hard landing right now, and nor does it really feel like a soft landing when you look at the strength of the Atlanta Fed's tracking model for real GDP, which is tracking real GDP at an increase of 5.6% in the third quarter, with consumption up by over 4%. Even residential investment is tracking at a 7% increase annual rate after several quarters of being in decline. Hence my conclusion that some of these rolling recessions are actually turning into rolling recoveries. Let's look at another chart relevant to the history of soft landings. Can they occur? Have they occurred? And the answer is they have occurred. And so you can look now at the manufacturing PMI. and see that in the mid 1980s, we had the MPMI fall below 50. In the mid 1990s, you can see a more clearly the mid-cycle slowdown in the MPMI here. And then in the 2010s, I should say, 2014, 15, 16, you had a mid-cycle slowdown. This was more of a slowdown related to the global economy. Europe was falling into a recession because of some of its debt crisis issues back here. But again, no official recession in any of these three environments. And I think we're again in a mid-cycle slowdown or a soft landing. Now, all of a sudden I have to defend, well, why is it a soft landing at all? Why isn't it no landing? Why isn't it actually a boom? Is it possible that the much better than expected growth in the third quarter is just the beginning of better than expected economic growth going forward? I sure hope so. I tend to be an optimist at heart, but I try to be realistic about these things, and it just doesn't look like things are set up for a continuation of this strength. So I think we're going to go from what I'm calling a strong patch back to a soft patch very quickly here as the year ends and going into the new year. We can discuss that in a minute when we discuss the consumer, because the consumer clearly is the key. Powell has indicated that he wants to see more slack in the labor market. Not seeing that yet in the unemployment rate. Seeing some moderate increase in initial unemployment claims, maybe going from 3.5% to 3.8% on the unemployment rate in August is the beginning of some slack. As we know, the unemployment rate is always at a cyclical low right before recessions. That's the nature of the beast. And so you can kind of look at this chart and still worry about an impending recession because it's always this low right before a recession, but that's not my scenario. So labor force, we've seen the labor force continue to increase to a record high, which is good news. The question is it increasing fast enough to accommodate the increase in demand for labor? And you can see that household employment is a measure of the number of people with jobs, whether it's one or two or three jobs, whereas the payroll employment is the number of jobs. And these are all continuing to increase. Let's look at the participation rate. You can see that the participation rate in the labor markets have increased. The participation rate is simply you take the number of people in the working age population and you multiply them by the participation rate. That's how you get the labor force. So the labor force is really pretty simple arithmetically. It increases if the working age population increases, which it is, though it's increasing at a slower pace for demographic reasons. You'd like to see the participation rate increasing or high enough so that means that more of those people are in fact working, adding to the supply of labor. Well, let's look at the most recent data, and what we see is that the labor force did increase because of the increase in the participation rate, and it increased substantially by 736,000. You can see that household employment, you want to compare apples to apples in this case because the labor force and the household employment are from the same survey, and they're the ones that determine the unemployment rate. But you can see the household employment is increased by 222,000, by a lot less than the labor force. But these are all pretty volatile on a month-over-month basis, so you can't make much of it. But again, we'll take what we can get. Labor force increased more than household employment, and that's what we want to continue to see in terms of, that's what Powell wants to continue to see in terms of what some of the points he made for turning less hawkish and stop threatening us that he's going to be raising interest rates. By the way, I was reminded by an account recently that I think it was back in the summer of 2020 that Powell famously said that he's not even thinking about lowering interest rates, and it wasn't that far past that where he was sorry, let's do that again. He said he wasn't even thinking about raising interest rates. And it was March of 2022 that he started raising rates. And with the benefit of hindsight, he probably regrets that he didn't start increasing interest rates sooner in 2021. But now he's effectively saying that he's not even thinking about lowering interest rates. So hopefully that'll be something that's proven to be that's disproven in the next within the next 12 months or so. But for now, he's made it clear that they're going to keep rates at these levels. Well, so we did not get much improvement relief in the supply of labor when it comes to the average weekly hours. You can see the demand for labor really did increase here, as you can see, but it's back to normal. So it's going to be volatile. It's back to normal. So the work week is back to normal. You really don't expect that to go up or down much. Obviously, it would go down in a recession, but that's not our scenario. That's not what Powell is angling for at this point. Powell must have been very pleased to see that the job openings data shows that there are fewer job openings, but there's still a lot of them. And you can see that job openings relative to unemployed workers is still quite high at 1.5, and that's still above the pandemic level. So we're going in the right direction, but the labor market is still tight from that perspective. Here's another indicator of the labor market tightness. Consumer confidence survey has something called jobs availability, jobs plentiful versus jobs hard to get. The jobs hard to get is very highly correlated with the unemployment rate. So it's inched up just a tad here. Meanwhile, this is confirming the job openings. Jobs plentiful have been coming down, very highly correlated with job openings. So these things are moving in the right direction, but clearly not at levels that would suggest that the labor market has fully rebalanced in a way that Powell would like to see. And as I said, he'd like to see wage inflation coming down to around 3%. There's about 3 or 4 measures of wage inflation, and they're all in the 4 to 5% range. We did see the year over year in the average hourly earnings edged down to 4.3%. It had been up around 5.5% at its peak last year. So it's making progress, but we're still not talking about getting under 4%. Moving towards 3%. So that's something that continues to be a concern for Powell, the Fed, and for those who believe that inflation still could very well come back if we get another inflation shock from energy or food, and that feeds back into wages. Of course, there's another story out there, which is that while labor unions now account for only 11% of the private sector employment, they are getting some pretty impressive increases in their pay and their benefits, and that could spill over into the other non-unionized part of the labor market. But I don't think it will, but it's one of the concerns of why this may not come down as quickly as one would think, given a labor market that seems to be going in the right direction and rebalancing. What about the consumer? Consumer has been the source of the economy's strength. A lot of that has been attributed to excess savings. I'm working on that story again today for tomorrow's morning briefing. And I don't know, I just can't get into this fear that people have, that the pessimists are promoting, that consumers are about to run out of excess saving. And when they do that, they're going to suddenly save a lot more. Therefore, they're going to spend a lot less. And we're going to have a consumer-led recession after all. It seems to me that it's true that people did save a lot during the pandemic years of 2020 and 2021. It's true that the net worth of consumers rose dramatically during those 2 years. Some of that had to do with the stock market going back up. Some of it had to do with home prices holding up remarkably well after being up dramatically during the pandemic. But we also know that consumers accumulated a lot of liquid assets. Some of it was money rain, the helicopter rain that the Fed provided consumers, and that the checks that the Fed validated in terms of the checks that were dropped from helicopters into people's deposits by the fiscal programs of pandemic relief checks. Well, let's have a look here. The consumer's been doing well all along here since the pandemic. We had the lockdown causing them to cut their spending. Obviously, they couldn't go shopping. Then, when the lockdowns were lifted, they had cabin fever. They were depressed. They needed to feel better. So shopping does that. It releases dopamine in the mind. And as you can see, there was a tremendous surge in consumption of goods. Services took a while because they were more restricted through social distancing requirements, restrictions. But goods consumption went way off track to the upside. And now it seems to slowly be moderating back to its trend. And there's every reason to believe that it can just, once it resumes the trend, it gets there. But you can basically argue that we've had a growth recession in the consumer goods area for quite some time. And meanwhile, the services have gotten stronger and stronger as the social distancing restrictions have been eliminated, and people have had wanderlust and decided to go on trips, decided to go to the restaurants and enjoy themselves more with services. By the way, my wife and I still are suffering from wanderlust, and so we're going to actually go away to Scandinavia next week. So I know I'm not going to have a recorded. I'm not going to have a live session for you of this web chat, but I may be inspired to do a recording looking at some of these issues with regards to the consumer. But so we're going to be contributing to the services consumption here, as I think a lot of consumers have been doing. But this looks like it's going to continue to move higher. I don't see why suddenly consumers are going to say we've run out of excess saving. They've accumulated a lot of net worth. Net worth is almost at an all-time record high. Does it suddenly mean that they have concluding that they're not saving enough and they have to save more? I'm not convinced of that. And if they do that, it's not all going to happen in 1 month. So it could be a gradual thing. And it would be consistent with our view that this strong patch is going to give way to a soft patch again. So we're not expecting consumers to keep up this pace of spending. Speaking of spending, one of the driving forces is the earned income proxy. That's the red line. That's a proxy that we calculate on a monthly basis. When payroll employment comes out, we take total hours worked, multiply it by wages, and that gives us wages and salaries, which we call the earned income proxy. And it's very highly correlated. It's a good indicator of wages and salaries and personal income. So it hit a record high. I think it's increasing somewhat faster than price inflation, just a bit faster. So there are real income gains there. But again, retail sales have been flat because there's been a recession in merchandise and goods. But overall, we see consumption continuing to increase. Here's consumption again in real terms. Here's disposable personal income. It was actually quite weak here during 2021. And consumers did use some of their excess savings, clearly, to offset that weakness in real disposable income. But now our argument is real disposable income is growing. And unless they decide to really dramatically increase their savings, consumption, it should more or less increase with disposable income. Here's that savings rate. And the fear is that after seeing it spike here with the accumulation of excess saving, that the savings rates come down during 2021. That drop helped offset the weakness in disposable income, so the consumers kept spending. But the question is, what do they do now? They say, oh my God, we've run out of excess savings. Let's jam up this our personal savings rate. Not necessarily. I think the savings rate could remain low because they did accumulate a lot of net worth back here. I've also made the point that half of net worth is being held by baby boomers, and more of them are retiring. As they're retiring, they're not earning a paycheck. Maybe they're getting interest income and dividend income, but their savings rate is likely to go down. And what's the point of accumulating all that net worth while you're working, well, it's to retire and to start using some of that accumulated net worth for retirement purposes. So I think this may very well stay low. And again, this is just a chart of the underlying demography of seniors and the seniors citizen population, especially those in the labor force and in both the labor force and not in the labor force. This is not in the labor force, as you can see, and this is in the labor force. Both are being boosted by the aging of the baby boomers, but the old gray mare, she ain't what she used to be. As the baby boomers get older, 65, maybe a lot of them are still working. As you can see, they're still aging and still in the labor force, but they may be starting to slow down as the oldest of them start to turn 75. And we'll be watching that closely. So again, this is the net worth of just the baby boomers. If I were to double the scale, you'd have the net worth of the consumer, and there's a lot of net worth out there that's been accumulated. How about inflation? That's the other one that the Powell would like to see go in the right direction. So he wants to see price inflation, wage inflation go in the right direction. We mentioned wage inflation. He wants to see labor supply demand go in the right direction. I think there's some evidence that's happening, and he wants to see some slowdown in consumer spending, and I think that's going to happen. It hasn't happened in the third quarter, but I think we're going to see it slowing down. So we are going in the right direction. We're still moderating in inflation, but this is a concern. The Fed has made it clear that Powell's made it clear that non-housing services inflation has been stuck around 4.5% for the past 2 years. It's encouraging to see that goods inflation has made it round trip. That was turned out to be transitory. But rent inflation, he's made it clear that he understands that it's a lagging indicator, could take a while, but I think that rent inflation is going to come down quite sharply in the coming months, and that may offset some of the stickiness we're seeing in this variable. But I think even this variable is going to show some moderation because a lot of that is determined by wage inflation, which I think will continue to moderate. This is the PCED excluding rent. That's the inflation number that came out of last week, and you can see that headline X rent is 2.6, and the core X rent is 3.6. So we're making progress in the right direction. We're still forecasting that both the headline and the core inflation rates go to 3 to 4% this year. We're already there on the headline basis, but it could bounce around. We need to see the core rate moving back down to this 3 to 4% forecast range that we have. And then next year, we think 2-3% is possible, maybe down to 2.5%. I don't know if we're going to see 2%, but maybe by 2025, we'll see it closer to 2%. And I think a lot of that's going to be based on our productivity story, the so-called roaring 2020s. So look, the soft landing's gone pretty well for us. Inflation is moderated in the right direction. We still have, all of us have a lot of uncertainty about what the Fed's going to do. A lot of it will depend on the numbers up ahead here. I think the market's already starting to get spooked about the CPI number that'll come out next Wednesday. We sort of go from CPI to CPI here in the marketplace. And so we'll be watching that along with everybody else. I'll be watching it from someplace in Scandinavia, and we'll probably send you a quick takes on it. I'll have my handy dandy laptop with me. I won't have Max with me. I won't have the Yeti with me. But like I said, I may record something for next Monday. So let's turn to the Q&A here. Tim, do you have a chart on your website which shows the implied Fed funds rate based on Fed futures? Yeah, if you let's do this real quickly. Hope I don't get myself into trouble here. Again, this is a homemade production, so it's not the smoothest. But let's go to the website here, and your wishes come true. If you go to interest rates and go to where did I put it? Federal funds rate. you can see that's somewhere here. I did it again. It's in here somewhere. Send me an email on it, and I'll let you know. But it's we definitely have it somewhere in our massive site of charts. Did I maybe just pass right by it? I mean, this got the 12-month futures, so you can look at that. But I'm sorry, there it is, right there. I went too fast. Figure one. I'm not losing my mind yet, so you can look at that, and that looks like nearby is 5.35%, then 5.42% 3 months. 6 months back down to 5.35, and then 12 months ahead, they're looking at 4.77. Okay, so let's go back, stop sharing, and let me take a couple more. I'm running out of time here. Vincenzo, do you expect fiscal policy to be expansionary, restrictive, just like now, going into the 2024 elections? We're locked into a very a very profligate fiscal policy. It's very stimulative, and a lot of money has been allocated for infrastructure spending. A lot of it's been allocated for this so-called Inflation Reduction Act, which is basically has a lot of Green New Deal spending in it. So fiscal policy is inherently stimulative here. The rising net interest expense of the government, the rapidly rising net interest expense of the federal government, is in some ways stimulative, right? Because it means that there's more interest income to holders of the Treasury securities. Ian, where in Scandinavia, Copenhagen, Norway are? I'm going to all of the above. Copenhagen, going to Norway, Sweden, and Denmark. The bread and pastries are delicious. Yeah, my wife is looking forward to the Danishes. Okay, one last question here from Ian. With the Fed banks running deficits, paying 5% on treasuries and the cost of servicing the deficit of 30 trillion, don't you think the Fed will reduce rates in 2024, regardless of what Powell says? Inflation has rolled over and is coming down. Well, that's my scenario. It better work out that way, because if inflation makes a comeback, or if it doesn't come down enough and interest rates stay at these levels, the compounding of the debt continues to be a problem. With interest rates this high, that continues to be a problem for the banks, because they do have to pay higher rates for their deposits in order to keep their deposits from going to money market funds. So we do need to take some pressure off of interest rates, but it's not going to happen just because the Fed feels that they need to do that to take the pressure off of the compounding effect of interest on the fiscal side, nor on the banking side. It's got to be justified by the underlying fundamentals, and I think it will. But look, September is viewed as an ugly month more often than not for the stock market. It's only been really bad 55% of the time. 45% of the time it's actually been up with the gain. So maybe we'll be lucky this time. Then again, it looks like the fiscal drama will unfold once again with a possible shutdown, maybe by the end of the month. But certainly there'll be lots of discussions about or debates about that happening sooner than that. So there will be things to worry about up ahead here. But don't worry. Try to be happy, or worry and be happy, I should say. That's the realistic story. Have a good week, and I will try to record something for you for next Monday, looking over some of our thoughts on the consumer and excess savings. Thank you.